Have you ever wondered how the multifamily real estate market is holding up amidst the rising tide of new apartment constructions? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into a report that sheds light on the current state of the multifamily real estate market. According to Dylan Lowe from the Baton Rouge Business Report, the multifamily market is showing signs of softening. This follows several years of strong occupancies and rent growth, but recent trends suggest a moderation in these metrics. The local apartment vacancy rate has increased from 5.36% to 7.46% over the past year. This rise in vacancies accompanies a year-over-year rent increase of nearly 5%, bringing average rents to $1.31 per square foot. However, it's worth noting that this is a slower rate of increase compared to the 10% jump seen from 2021 to 2022. A major factor contributing to the rising vacancy rate is the influx of new units entering the market. In 2024 alone, more than 2,000 new units were delivered, and an additional 1,793 units are currently under construction, slated for delivery either this year or the next. This wave of new supply is part of a decade-long construction boom, which has seen 12,934 units delivered between 2015 and 2024, marking an 86% increase from the previous decade. While these numbers are significant, there's a silver lining. Job growth remains a critical factor for absorbing this new supply, and the local job market has mostly recovered since the setbacks of the COVID-19 pandemic. Unemployment is now hovering around a historic low of 4%, although total employment did dip slightly year over year at the end of 2024. It's clear that while challenges exist, the multifamily market continues to evolve. As more units come online, the focus will be on how job growth and economic factors influence their absorption. Keep in mind, this is a dynamic market, and opportunities often arise in the face of challenges. Let's shift our focus to Alberta, where an unprecedented number of purpose-built rental units have broken ground in the first quarter of the year. According to Jimena Gonzalez from the Globe and Mail, developers are capitalizing on Alberta's affordable land prices, which presents an attractive opportunity for those looking to invest in the multifamily market. This trend is supported by the Canada Mortgage and Housing Corporation's MLI Select program, which offers lower premiums and longer terms to incentivize the construction of these rental projects. Raymond Wong, Vice President of Data Operations at Altus Group, highlights that despite a softening in rental rates, there is still a strong demand for apartments in Alberta. He notes that the numbers make more sense for builders in Alberta cities, where rents and the cost of building align more favorably compared to larger centers like Toronto and Vancouver. The program's requirement for developers to rent a portion of units at 30% of the area's median income makes Alberta particularly appealing. In Calgary, where the median family income reached $130,000 in 2022, the rental market remains attractive for developers. Genstar Development Co., a seasoned developer, has ventured into the rental market with their Atlas project, marking a significant shift from their traditional focus on land and condo development. Genstar's Atlas, comprised of 432 units across 4 mid-rise buildings, is set to welcome its first tenants this spring. Paul Boscovich, Genstar's president, emphasizes that Calgary's rental market offers a mix of affordable rents that still support new construction. This balance is crucial for purpose-built rentals, where high rents can increase risk profiles. Calgary's rental market is thriving, accounting for more than half of all purpose-built rentals currently being constructed in Alberta. Reed Hendry, Chief Housing Officer at the City of Calgary, attributes this success to a decade-long partnership with the industry, which has laid the foundation for the city's housing strategy, Home is Here. However, challenges remain, particularly with the uneven distribution of new construction across the city. Idan Lindenbach, CEO of GEM Properties, points out the bureaucratic hurdles and costs associated with building in Calgary's inner city compared to the suburbs. This has led to a concentration of development on the city's outskirts. The city of Calgary is aware of these challenges and is working to streamline processes and reduce red tape, particularly for mid-rise and high-rise projects. The upcoming Calgary Plan in 2026 aims to further enable multifamily development and address these issues. It's clear that while challenges exist, there are significant opportunities in Alberta's rental market, driven by supportive policies and a favorable economic environment. Our final segment today brings us to the Greater Toronto Area, where exciting developments are underway at the IP Park in Cambridge, Ontario. According to Steve McLean from RENX, Intermarket Properties is set to expand its 80-acre IP park with the launch of 3 new buildings. This expansion is a significant step in the site's master plan, which will eventually encompass approximately 1.5 million square feet of industrial and data center space across 15 buildings. The IP Park's strategic location near Highways 401 and 8 makes it an ideal spot for industrial and data center facilities. With neighbors like the Healthcare of Ontario Pension Plan's iPort Cambridge Logistics Campus and major players such as Loblaws, Amazon, and Toyota, the park is well positioned to attract businesses seeking proximity to established supply chain networks. Intermarket Properties has already completed 3 buildings at the park, with a focus on small bay industrial spaces under 150,000 square feet. The first phase saw Angstrom Engineering purchase 1 building, while the other 2 are fully leased, including a recent deal with Hongsheng Thermal Systems for nearly 45,000 square feet. The second phase of development includes the construction of buildings at 200 Intermarket Road and 155 Boychuk Drive, with the former set to break ground this month. This 85,878 square foot industrial building will feature a 24-foot clear height, multiple truck level and drive-in doors, and ample parking. Notably, over half of the space is already under letters of intent, highlighting strong demand in the region. In addition, a build-to-suit data center is planned for 175 Boychuk Drive. This project will benefit from the area's robust infrastructure, including access to power, fiber, and water, making it a competitive location for data center operations. The data center will also contribute to sustainability efforts, as excess heat generated will be used to heat nearby buildings in collaboration with the region of Waterloo. Intermarket's commitment to sustainability and tenant wellness is further evidenced by the integrated trail system and environmental initiatives at the park. This approach not only enhances the site's appeal, but also aligns with broader industry trends towards responsible and efficient development. It's clear that the IP Park is set to become a key player in the industrial and data center landscape of the Greater Toronto Area. As these projects move forward, the combination of strategic location, innovative design, and sustainable practices will likely drive continued interest and investment in the region. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.